First off, though, I'd really like to just stress how thankful I am for those joining us and anybody watching in the future. I know time is the most valuable resource there is. It's the only thing that you can't buy back, you can't get back. So just very thankful for everybody who trusts us and believes in us enough to come join this class with us. And so for those who don't know me, I've been in lending for about 15 years. Prior to mortgages, I opened and managed two subprime finance offices doing auto loans. During that time, while managing those offices, me and my wife, we actually bought a duplex, and we bought that originally with 3.5% down. We lived in one side, rented out the other side, known as house hacking, and then used the equity we built in that to actually buy a place out in Packwood as a short-term rental. And then from there ended up buying a third property that we own. So we own all three of them. All started with just that original home at 3.5% down that we then used the equity to buy multiple other homes. On the mortgage side, I've been on both the broker side and the realtor side, or excuse me, on the retail side with the lender and the broker side. On the broker side, we just have so many more options that we can help people with, and a lot more tools, and just love the different options from there. And so again, we've got Jody Williams here doing this as far accredited financial counselor, and I'll just toss that to you to let you give a little spiel about yourself.
All right, thanks, Jason. I appreciate it. As Jason said, I'm an accredited financial counselor, and what that means is I help people with daily money management. So whether that's creating a budget, helping people be able to stick to that budget, paying down debts, improving their credit, kind of helping with money mindset. That's basically what I do. I love doing it. I love to be able to see people really make changes in their financial situation. It can be obviously one of the most stressful things that we deal with in our lives. It's the number one reason people get divorced and whatnot, and people can get sick from the stress. So whatever I can do to help people kind of overcome that, I really enjoy doing it. I've been doing it for a few years, about 3 officially, as an actual job. And I was just doing it as kind of a hobby before that. Again, because I enjoyed it and just wanted to get that information out to people that I know. So I will pass it back to you, Jason.
Yeah, and you're so right, unfortunately, about the amount of strife that money causes in people's relationships. So many divorces, including my own parents getting divorced over that. And unfortunately, my dad's the one who's bad with money and has now had 3 divorces, all caused due to very similar things. So having that financial management is definitely an important thing for personal life as well.
Yes.
So, just a little bit about what we're going to talk about today. Just doing a quick look about the housing market, where it's been, where it's going, along with the benefits of buying in today's market. We all know that rates are high right now. We'll go over that, but on a historical average, we're actually still a little low compared to that, but have definitely gone up significantly in the last year plus. Then, how to improve your credit and planning and budgeting for homeownership, and along with whether or not it would make, if you are a homeowner, whether it would make sense to refinance, when it does and when it doesn't. And then, of course, questions and answers. So just jumping right into it, this is a chart as far as the rates over a little over 50 years, really the whole historical data since we've kept track, and rates as you can see, and as a lot of people lived through, rates hit 18%. Back in the 80s, people were still buying a home, still made sense to buy a home. Even at today, as I was saying, we actually peaked up over the historical average, came back down. We've been bouncing in between about 6-7% over the last 6-7 months. But even in that range, we're still pretty close to historical average. We're probably never getting back down to a sub 3%. There is a lot of technical reasons why that was ever even possible. But it was basically government buying it down to help due to COVID and everything. But getting back into the 3-4% possible. I should say 4 or 5%, excuse me. And then, sorry, and Jody, was there anything you wanted to add on this?
No, just wanted to say, yeah, that's too bad, that we might not get back down to the, sub 3. Because that's a great rate. That's where I bought my house at. So,
And I refinanced, I actually bought a house during that time, and I refinanced the house, 2 houses during that time. So don't get me wrong, it's a fantastic rate, and it's often what a lot of people refer to as golden handcuffs, because it's great. However, then when that home no longer makes sense to live in for one reason or another, expanding house, more kids, what do? How do you get into a bigger house and have that type of payment shock? But it's great, but as you can see, it's just historically not something that normally happens.
right. But hey, we're better than the 80s. So
Exactly. And it's very unlikely we'll ever, I shouldn't say ever, but in the coming years, it's very unlikely we'll skyrocket back up there, but it's possible. You never know. The rates follow actually a bond market, similar to a stock market, and things go up and down all the time, and just what people invest in. This is looking at appreciation, and really same thing going back as far as we have data. 73 of those years, all of the green numbers, out of all of those years, 73 times homes have appreciated on a year-on-year average. Only 7 times has it gone down, and you can notice that 5 of these are during the 2008 housing burst, and that housing burst was significantly caused by supply and demand economics, and we're in basically the exact opposite of that right now. We have exceptionally low inventory compared to pre-pandemic times, and the demand is still there, and the demand is growing due to population. So rates are curbing that demand, but there is still demand out there for sure. And in a 10-year cycle, if you look from 2007 through 2017, there's been no time where in a long-term 10+ years, homes have not appreciated. So it's homes have a very great chance of appreciating, gaining that long-term value over the years. Anything on that before jumping on?
no, I mean, just to say that, home ownership is still a great investment, puts a roof over your head, and hopefully based on these numbers too, looking historically, is still going to net you some sort of appreciation when it is time to sell or change up.
Absolutely. And it's also one of the most common ways for people to build wealth as a normal citizen. This chart shows and this is survey of consumer finances. Anybody can go and pull this up. This shows net worth by housing status. This particular is based on renters, and you can see here this is in thousands. So we're right here at about 6,000 of net wealth for somebody who rents, which just really isn't much. Definitely isn't much anything to be able to retire on or really build a financial, long-term life on. However, when we jump to displaying with owners on there as well, now we notice that this jumps all the way up into the 200s, really about 250 range, which is why, again, homeowners are on average 40 times wealthier than renters. So again, it's just historically a great way to build wealth.
I see that with some of my clients too, is the difference between people who rent and buy. And I think there's also probably age comes into factors too, because
Absolutely.
Younger people have less assets and are more likely to be renters than homeowners, but it affects older people as well.
Absolutely. It's kind of like the best buying what is always best in the past, so when you were younger and able to buy a home, fantastic, and the longer you've had that, the more wealth that you build over time. So kind of as this goes over, really the best time to buy was always in the past. If you could bought 10 years ago, great. 20 years ago, even better. 30, fantastic. And you're just building that over time. In the short term, though, unfortunately, compared to renting, in a lot of times, and especially right now, a lot of times it's actually not a good financial position on a cash flow only basis. This is looking at homes in Pierce County, based on average rental values for a similar size. And this is based on a $350,000 house. And you can see, to start with, if you may be buying and going up, basically $700 a month. And that can be hard to stomach to start with. And that cash flow, rents do typically increase, on average. Over the last couple of years, we saw as high as 18% year-on-year rent increases. Pretty insane amounts. On average, you're looking closer to 6%. And when looking at that, again, the best time was always to buy a home in the past. You're looking in this particular scenario, 6 years. And then it's just likely to get from there be better that you would have bought than rented. And this is also factoring in things like maintenance and repairs, property taxes, all that type of stuff as well. And again, even in just looking on a cash flow basis, even throughout that whole time frame, the cash flow, you're likely just on that, renting may be a better option. However, when looking at appreciation over that time frame, along with armorization, really you're looking at a huge net benefit of buying and keeping a home long term. Again, in the short term, may not be the best choice depending on the life circumstances, but in the long term, you almost always win out by buying a home. Armorization, for anybody who doesn't know, that is simply paying down your mortgage. That is literally making your payment. Part of it goes to principal, part of it goes to interest. The pay down of the principal is your armorization. And that's literally basically taking money from your paycheck and sticking it into a retirement account. It's forced savings that helps people build wealth that way. Anything to add on to that?
No, I mean, I think you said that very well. It's much better to be paying towards that house that eventually you'll get back versus, making your landlord rich.
Right. Then I'll let you jump on this one.
Okay, so ways to improve credit. Always, like, probably one of the first things you want to look into if you're looking to buy a home or maybe even refinance is to take a look at the credit and find out where you stand, because of course that's what the mortgage company is going to be looking at. Not the only thing, but one of the major things they'll look at before lending you money. What I recommend is, first and foremost, is getting a copy of your credit report. And you can do this free by going to annualcreditreport.com. It's a great thing to do. There's 3 different credit bureaus, and you can get one from each bureau once a year. At least that's the normal circumstances. Right now, during COVID, they made it so that you could get one every single week, and that is still standing. I don't know when they're going to end that. Yeah. So this is a great time. If somebody's trying to work on their credit, they can go in every week and pull a new credit report. So that's fantastic. Again, not sure when that's going to end. They haven't put an end date on that. So take advantage right now if you need to do that. But anyway, that would be your first step, is go in, get a credit report, take a look at every item on there and make sure that there's no problems. If you see errors, whether that's, misspellings of names, or they've got wrong addresses for you, or maybe there's loans or credit cards on there that you've never had, which it does happen sometimes. Go in and get those things fixed, which is why I tell people, if you can, start 12 months out from when you're really looking to get that mortgage or get a loan of any sort, to be able to make those changes. Because when there are errors, they don't happen very quickly a lot of times. Whether that's contacting the credit bureau to make those changes or specific creditors, maybe you have some derogatory things on your credit report, that takes time to turn around and to get that good credit added on. So just keep that in mind. It's not an overnight thing. And then as far as being able to check your credit score, there's two different kinds of scores. There's the Vantage score and the FICO score. And FICO is the one that mostly mortgage companies use. Vantage score is something that you can get through like Credit Karma. And a lot of times if you are getting credit scores through maybe credit cards and things like that, a lot of times they use the Vantage score. So those are options for getting your credit score for free and being able to watch that. But you can also get your FICO score for free as well. When you do go into annualcreditreport.com, it will ask you if you want your credit score, but they're going to charge you for it. So what I recommend is go to myfico.com, and there is a free option. There's several different subscriptions that you can pay for in there, but you can just get a general score. I believe it's once a month, and that's all you get. There's no monitoring or anything. They just give you the score once a month, and that is free. So if you go into the site, you'll be able to find it. Just look around, but it's a very useful thing. So speaking of derogatory information on credit reports, just know that if you ever had anything on there like late payments, collections, things of that sort, they're going to stay on your credit report for 7 years. Now, the further back they are, the better your score will be, but they are still going to show on there. And so bankruptcies too. So one bankruptcy will stay for 7 years, which is a Chapter 13, but a Chapter 7 bankruptcy actually stays on for 10 years. So that's the only derogatory stuff that would stay more than the 7. So just know, like if you have collections and things that were on your credit report, you know, the further back they are, like say they're 5 years ago, 6 years ago, something like that, your credit score should show, as long as you've got good history since then, your credit score will start to go up. And what I would say though, is if you can get those things paid off, you know, let's say if you're in the first 5 years of that happening, it's a good idea, get in there, get that stuff paid off. You're always responsible for it. But what can happen is, let's say your bad information was 6.5 years ago. If you go in right now and pay that off, I hate to say this, but if you go in and pay that off, it's going to reactivate the time on that derogatory information, and it's going to stay for another 7 years. So sometimes what people who help with credit will say is, if it's that far back and you know it's going to fall off your credit report very soon, that might be the better option. But I would always say, reach out to somebody who specializes in credit and kind of get an opinion about your specific information.
Absolutely. And a couple things to add there is, sometimes you can get, when paying off a collection, you can get what's called a pay for delete, and they'll actually fully remove it. And if you can do that, you know, then that's a great option. Or negotiating the balance down too can sometimes be a good option. You know, if you got $1,000 balance with $2,000 in interest because it's been 3-4 years, whatever, you know, sometimes they're able to waive some of that and negotiate that off there. And in regards
Absolutely.
to the bankruptcy, that as you were saying, staying on there for 7 to 10 years, that's how long it's going to show on the credit report. That doesn't necessarily mean it's going to stop you from doing things for 7 to 10 years. You know, as you were talking about building credit, you can still, you know, a lot of times go out and get, you know, an auto loan or credit card, start building that. And then same thing with a mortgage. There's a lot of programs that can be able to refinance or buy a house when you're 2 to 4 years out, and depending on the program and depending on the type of bankruptcy, as low as 1 year or even while in, you know, bankruptcy. So bankruptcy, it can definitely hurt, but there are ways to mitigate that.
Right. Thank you. I appreciate you adding that. And so next, what I was going to talk about is, then while you are dealing with those things on your report, what you could do is building and start getting good credit, which then will affect your score as well. So next slide, please. So here is how they drive your credit scores. So your overall score, 35% of that is your payment history. So that's the number one thing you can do is pay your bills and pay them on time. For building credit, that's number one. Next thing is your debt to credit ratio. That's 30% of your score. And it's also your credit utilization. The best is 30% or less. So for example, if you've got a credit card with $1,000 limit on it, not spending more than 300 is best to keep that credit score good. Then 15% of your credit score is the length of credit history. So on this one, a lot of times people will say, oh, maybe they've got 4 or 5 different credit cards, and as they want to pay them off, and they want to just pay them off and close them. But that's not always the best thing to do if you're trying to improve your score. Pay them off and then just keep them. Maybe use them once a year or something on something that you're going to pay off right away, just to keep them active. But that can really help, because then your credit utilization is higher, and then you also have a long credit history. So you don't want to close out stuff, especially if you've had those cards for a long period of time. Next is credit inquiries. So anytime somebody does a hard pull on your credit for applying for credit cards, applying for any kind of loans, applying for apartments, sometimes they'll do a hard inquiry, and that's 10%. The great thing with inquiries is they only stay on your report for 2 years, and over a 30-day period, let's say you're looking for an apartment, and so you apply at several different places. That'll only show up as one ding against your credit, instead of like 4 or 5 times for every time that they've looked at your credit. So that's a plus. So it's a small percentage, but just keep that in mind. I wouldn't necessarily, if you're trying to build your credit, go out and open a bunch of credit cards, or, go on a shopping spree and get like every store card because you get a discount that day. I've seen people do that, and it does affect them a little bit. And then the last thing is another 10% is your mix of credit. So having a good combination between revolving versus installment. Revolving is credit cards, and your installment loans is like personal loans, vehicle loans, and mortgages. So having a little bit of both also enhances your credit score. As you can see in my little gauge there at the bottom, your ranges for the different kind of scores. You want to jump in here, Jason? And as far as mortgages go, where do you guys usually offer loans?
Yeah, that's a great question. So really where the typical is going to be fair and above 640, as we got here, that can qualify for every program, including things like a down payment assistance program and everything. We do have all the way, there are loans, typical FHA, 3.5% down. That actually goes all the way down to 580. Some lenders will require a little higher than that, but as far as FHA guidelines, and what we can do is 580. And then FHA will actually go all the way down to a 500 credit score with a 10% down. So just need a little higher down payment to do that. And VA technically doesn't have a minimum credit score. They're looking at more what's on the credit. I would say that even though they technically don't have a credit score, they do still, want to see a little better in that 580 or above range. But even no matter how low we go, the rates and fees are always going to be better the higher the credit is. So, there's been multiple times where we have the availability to help somebody do maybe a VA loan in the 500 range, but it's better to go ahead and fix a couple things and get them up into 640, maybe into the low 7s, because sometimes a small tweak to the credit can make a huge difference. So doing that, sometimes it is better to wait, even if can qualify for something now. It just really kind of depends on life circumstances and everything else.
Great, thank you. That's good to know.
And I assume you're ready to jump on?
Yeah. So maybe if you don't have any credit just right now, or you just want to build better credit, maybe push some of that negative derogatory stuff down. The things that you can do, first and foremost, is have credit and use it. You can't get credit if you don't have it. So having a credit card and just using it on a regular basis is the best thing you can do. So using it for everyday things like groceries and gas, utilities, things that you can charge to your card, and then you pay it off every month, so it doesn't end up costing you anything in interest. But it's showing that you are responsible and you have good credit history, good use of that. Now, if you can't qualify to get a regular credit card, a lot of banks have secured cards. And what that is basically you put the money down and then the bank holds it as collateral and they give you the card. So for example, maybe they give you a $300 credit limit. You would have to give them $300. They hold on to that. You use it and you pay it off monthly, just like a regular card, but they've got that $300. So just in case something were to go wrong, they'd have that to cover the bill. And a lot of times, once you get a secured card and you use it responsibly for a year or so, you can talk to your bank and then get it converted to a regular credit card and get your money back. So just an idea there. And then as far as getting some sort of installment loan, what you can do is go to, or get a self loan, which is self.inc. And what this is, it's a great program where you can start building credit. This is good for really young people who may not be able to get like a card or to do it in addition. And it's basically, let's say you want to set up a $600 loan. So, and you would pay that off over a year. So every month you would pay $50 towards this loan. They report every month to the credit bureau. So it starts building that credit. And then what happens is at the end of the year, when that's paid off, the $600, they give you your money back minus some fees. So the fees are different based on, you know, how much you're putting in and whatnot. But if you're trying to build good credit, it might be worth spending the little bit of money in fees to do that, because then you've also saved some money as well. So if you do these two things, use your credit responsibly, use it regularly, have that mix of credit, I mean, nothing's going to happen, but your credit score is going to go up, right? So best thing you can do.
Yeah, absolutely. Can I actually, it's not on here, but you were telling me about a thing with you that you did with your daughter, another way that to help people build credit from starting very young. Do you want to touch on that maybe?
Yeah. So something you can do with a child, or maybe you have a friend or another family member who can help you out. If maybe your credit's not so good, is putting them as an added user on a card. So what I did with my daughter when she was 16 is I made her an authorized user on my credit card. She has rules around when she can use it, right? She gets permission from me to use it for certain things, but by that card being in her name, she's built credit. And in 2 years, her credit score, we checked not too long ago, was like 795, just from having her name on my credit card. So it's awesome. You know, maybe in the next couple of years when she has to go purchase a car or something like that, she won't need a cosigner because she's already going to have good credit on her belt. So if you have bad credit, you know, maybe a family member could do that for you, or a friend, or somebody else. So something to think about.
Absolutely. And the nice thing is on the mortgage side of that, we can actually even disclude that debt because you're just an authorized signer. The authorized signer person, we can actually just say that that's not a debt, not a payment, that person is affected on their debt to income ratios and whatnot. So it's really kind of one of the best of both worlds.
Oh, that's awesome. I actually didn't know that.
There can also be times where we can exclude like auto loans and other stuff like that if we can prove that somebody else is making a payment. So same thing, like if you in a couple years you co-sign for your daughter and then you were trying to buy a house or something and your daughter's been making the payments the entire time, and we can show history of that. Has to be at least a year-long history and through, you know, bank transactions or whatnot, be able to show that they're making the payment and not you. We can actually remove that from your liability section as well. So
that's excellent.
Yeah. Speaking of which, jumping into really kind of determining how much somebody can afford for a mortgage. both on the lender side, but also on what you can afford, because that's an important aspect. A lot of times, we end up saying more than you feel comfortable.
Right. So, can you afford what the mortgager says? Maybe and maybe not. So as Jason alluded to, is they give you a max amount that you can qualify, but sometimes that's not always best for your personal situation. So it's really important, if you are looking to get a mortgage, that you need to figure out and analyze your own finances to find out what you feel comfortable with as well. Because even maybe if you can make the max payment, it might make you feel uncomfortable and cause you stress because maybe you don't have a lot of cash flow, kind of like what Jason was talking about earlier. And so just really knowing what your figure is for you and your own personal budget and situation. Because it's important, although a mortgage and owning a house is a great investment, and I recommend it to everybody, you need to know and be able to live the life that you want, right? While having that house. You don't want to be house poor, and like every penny that you have goes towards your house and you can't do anything fun. So really being able to take a look at that and knowing what you can do. And what I tell people to do is basically look back at your last 2 full months of both income and expenses and be able to make a budget. So, income minus all your expenses, find out what's left over. Excel's a great tool. There's also some great calculators you can use online and other like budgeting programs where you can go in and kind of play with numbers too. So you could, hey, maybe my new mortgage, I think it might be $3,000. You could plug that in with your current numbers and kind of get a feel for, if you're going to have enough for everything else that you're spending during the month. And it's also important to take in consideration not only your monthly expenses, but your annual expenses. A lot of times people will forget about, that subscription that they have to something that's only a yearly thing. So taking that into account, because maybe when the month comes up where you have to pay that annual fee, maybe you can't afford to do it, right? Because you've only been looking at monthly things. So a great thing to do is really break that out into 12 payments when you're building a budget, so that you know that you can afford that. And what I tell people too is to be able to put that money aside every month. So when those annual expenses come around, the money's sitting there, right? And you can pay it and it's not kind of a strain to the budget. Some people can handle it, others, it's a little bit harder to, make the annual payments like that. So just keeping all of those things in mind. And really, when you build this budget, you want to build it around your values and think about what's important in your life. As I said, you want to be happy. You don't want to be, feeling like you're stuck because you can't really do anything fun because you have a house now. So take into consideration your hobbies. Do you want to take vacations, and how often, and how much do they cost? And being able to budget those things in to the monthly expenses. So that when you do get the mortgage payment, there's no stress involved in being able to pay that and live your life. And then the other thing that I really recommend is, if you are going to buy a house, build an emergency fund if you don't already have it. One of the most important things, as we saw, during COVID, is a lot of people didn't have emergency funds. And so they weren't able to make payments on things when they lost their jobs due to COVID. And so, there can be a lot of struggles around that, whether it's mortgages or credit cards or car payments, or even just having money to eat, and basic necessities. If you lose a job, it's nice to have some money sitting in the bank to be able to cover that. Or in homeownership too, you have to take into consideration other sorts of emergencies like home maintenance. If something breaks, if the water heater breaks or the furnace breaks, you need a little chunk of change to be able to take care of that and not get yourself further in debt. So they recommend 3 to 6 months of living expenses. So just keep that in mind. It doesn't mean you have to have all of that up front when you buy your house, but at least have some, excuse me, and then maybe work towards, building that up while you have your home as well. Any input there, Jason?
Yeah, I was going to say absolutely. And I know for a lot of people that it's very difficult to really pull themselves away from their life and really look at all of those different pieces. So a shameless plug here, this is a great time to meet with a financial counselor like Jody, to somebody who can really remind you of and dig into some of those questions of, well, what about this common expense? What about this? What about that? And where a lot of people don't necessarily think about all the things that are involved. And then also sticking to that budget, as we mentioned before, budgeting is not just important for a mortgage, it's important for life and for, marriage. Really sometimes also having that third party, not to necessarily say a mediator, but sometimes, having that counselor mediator, in a marriage and a budget and saying, no, this is the plan we made together and that we need to stick together and whatnot. That can also be a helpful in just that aspect of it as well, of having a third party help with that.
Yeah, exactly. And thank you for saying that, Jason. Yep, that's exactly what I do. If you're looking to, get the mortgage, buy the house, and you need help doing all these things that I'm talking about, that's what I do on a daily basis. So, contact me. I'd be happy to help you through those things. And then even beyond when you get your mortgage, again, sticking to the budget and keeping you on track and planning for your future as well.
Absolutely.
And here's a good template for building a budget, is basically the 50-30-20 method. And what that is 50% of your income goes towards your mandatory needs. So the housing, the transportation, insurance, food, healthcare, the things that you cannot live without. 30% goes towards your wants. So here's your fun things, your entertainment, going out to eat, concerts, date nights, whatever it may be, the fun part of life. That's 30%. And then 20% going towards financial future. So that can be either paying down the debt that you've already got, or really trying to put at least that amount towards savings for your futures. And whether that's, your emergency savings that you need to build up for the home ownership and for your future, paying for kids' college, your retirement savings. Maybe you have a vacation fund because you're looking to take a vacation soon, So you take all the things into account that you want in your life, and then you sort of divvy up your money. And if you can do that, it's usually a good ratio to, keep you on track for your future and being able to meet your current needs as well.
Yeah, absolutely. And then do you want to go over this one, Jody?
Yeah, sure. So as I alluded to before, when I was talking about budgeting and finding some cool calculators and things to be able to plug in numbers to, there's also some calculators out there online where you can plug in numbers to figure out what a mortgage payment would be. Jason has a few of them listed here. The calculator.net/mortgage. There's one on Zillow, one on Redfin. And what's really great is I love these things. I actually am looking to purchase a home too. So I go in all the time and I like to, plug in different numbers and see, what my scenario might be. But yeah.
Myself all the time, personally. It's a quick, easy way when you have the numbers right.
Exactly. So if you've got the numbers, you know the home price, about what interest rates are, how much you have to put down, that kind of thing. You can go and plug this in, and it's a great opportunity to at least get an idea about what a payment would look like. Now, things always vary, based on, property taxes and insurance and that sort of things. And because rates fluctuate, from day to day a little bit. But just for an example here at the bottom, a 300,000 loan is roughly $2,500 a month. And that's your principal, interest, taxes, and insurance. And so that can just really help somebody. Maybe you're renting right now, and let's say you pay $2,000 a month in rent, and you want to know for about the same amount, how much home can I afford? Or, maybe I can afford the $2,500. So maybe my range is only 300,000 for a house. And so you can play with it, but definitely this is where talking to a mortgage officer comes in as well. So here's Jason's plug is get with him, and he can really, dial in those numbers really good for you, and let you know, like, what kind of interest rate could you get based on your credit, and what the rate is today, and that sort of thing. So
Absolutely.
that's something that he's invaluable for. If you really are in the market, this is what you want to do, set up an appointment with him, and he can really walk you through where you need to be, or what you can afford.
Most definitely. And one thing, couple things is, one of the biggest things I see on these calculators is it always defaults. I say typically, but I've never seen it not default to 20% down. So you go into Zillow or Redfin, you look at this estimated your payment, and you're like, oh, that's not bad, I can do that. But then if you don't have that 20% down, that payment goes up, both because the principal amount goes up. It's possible the interest rate, may be higher than expected because of a lower down, but also typically there's mortgage insurance. Mortgage insurance, anytime you're under 20% down, there's mortgage insurance. So in this scenario, it's 3.5% down, but there is mortgage insurance. So just kind of, as Jody said, it's important to, speak with a mortgage advisor to learn what those numbers are. And then once you kind of have an idea of what those numbers are for you, how much you can put down, what, property tax in the area, I would say like the Zillow and Redfin are better about pulling in property tax and mortgage insurance than some of the other third-party sites. They don't have the same data. It really just kind of depends. These are better in other ways because you get a better breakdown. So there's good and bad to all types of, but just these calculators are fantastic when inputting correct data, but when inputting incorrect data, they're just incorrect. So.
Right, absolutely. And I just want to throw in a little thing with the mortgage insurance is not everybody pays that. If you are VA, then there's no mortgage insurance. So.
Great point. Yes, fair, absolutely. VA has no mortgage insurance. There are some loan programs, depending 20% down, you don't have to pay mortgage insurance. But the majority of typical customer would have a mortgage insurance. VA kind of has a mortgage insurance. They have what's called an upfront funding fee, which is basically a lump sum mortgage insurance at the front, unless disabled with at least a 10% disability rating, then that's exempt, which is fantastic. And the VA loan program is such an amazing program in so many aspects, from having a lower cost, typically lower rates. They have some pretty flexible guidelines on payments and other aspects, and is most definitely a fantastic program there. And then here are a couple other, just to kind of give an idea. So like at 400,000, you'd be looking at 300, about 3,300. Again, this kind of looking in the Pierce County area with rough Pierce County taxes and homeowners insurance. And then if you were in the 500,000, would be looking at about 4,100. I would say this 500,000 is probably more likely to have, a down payment, but not necessarily. A first time home buyer could, be at that depending on their income level and everything. And then speaking on that income level, since forgot to mention a few slides prior, typically the way that is derived is income. We're looking at your verifiable income that's been consistent. And then from there, we are looking at typically around a 50% debt to income ratio. That can be down to 40, up to 60. I've seen VA do over 60, depending on the situation, because they actually use a residual income calculation instead. But let's just say 50 for easy math. Let's say somebody makes $6,000 a month, or maybe the household couple makes $6,000 total. And so you're looking at about 3,000. From there, we have to take out any debts from there. So a car payment of $500 and a couple credit cards for $200. So let's say, $700 from there. That means now they would qualify for a $2,300 a month mortgage payment, including taxes, insurance, mortgage insurance if needed, and everything else. So again, that 50% isn't exact. It depends on the program and the customer and everything else, but it's a decent baseline to have an idea and be able to go from there. So again, just kind of a quick way when looking at these to also be able to determine what you might qualify for.
That's fantastic.
Yeah. Anything before jumping on? Anything else?
No.
So then kind of looking, let's say you own a house, in this scenario, looking at, as Jody mentioned, buying a house when rates were super low or refinancing a house while rates were super low, and other debts have creeped up since then. Does it make sense to refinance or not? What a lot of people look at is just simply their mortgage rate. And again, rates have gone up, since a couple of years ago. So depending on the situation, you may be looking at a 6-7%, maybe more or less, depending on the time and the situation. And it's hard to bite the bullet of saying, well, why go from a 3% to a 6 or 7%, whatever that may be. However, what people often don't look at is the other debts and the rates in that. So this just says loan two. Let's say loan one is a mortgage, loan two being a home equity line of credit. Because of the Fed's raising rates, that's raised. It doesn't directly impact mortgages, ironically enough, but it does actually directly impact home equity lines of credit, car loans, autos, everything else. Mortgages are based on a bond market, which is very indirectly related to the Feds, but not directly. However, home equity line of credits have gone up significantly in rate. So let's say somebody had a home equity line of credit and it's gone up. Now it's at, instead of 4 or 5%, it's 9, 10. In this case, an auto loan. I was just talking to somebody, this is actually based on a similar scenario. I was just talking to somebody, they just had to buy a brand new car, and it was 11%. And it's just ouch. And then let's say this loan 4 is a credit card. Credit cards are, I see them all the time in 24 to, I've seen them up at over 30%, 33, 34%. So when looking at that and you actually breaking it all down, a blended rate would be quite a bit higher. So 5.7. However, if you're still looking at a 6 or 7%, whether or not that makes sense to refinance may or may not. In this case, looking at that, going from 3% to even at a 7.125%, with there being equity in the home, paying off those other debts of about $2,300. In this case, it could make sense. If somebody was able to save $620 a month, that's substantial. That's a substantial thing. It's just, when doing something like this, it's important that you learn from those habits, you correct those habits, and don't get right back into the debt aspects. Anything before jumping to the next slide on that, Jody?
No, I just wanted to, share that, is because I have seen clients who they do a debt consolidation or a refinance, they pay those debts off, but then end up getting themselves right back into trouble again. So yeah, it's a great strategy to be able to pay that down and increase that cash flow. Just know yourself and be careful with the spending once that happens.
Absolutely. And kind of another shameless plug, doing a cash out refinance to pay off debts, probably should talk to somebody about budgeting. Just saying. Good time to talk to Jody about budgeting. Don't want to get back into the same situation. And then the other thing is, okay, well, I just added a bunch of debt to my mortgage. It's at a higher rate. I don't want to extend my loan significantly. One option is taking that $627 in that scenario, applying it to the mortgage and paying down the mortgage quicker. What that does is, in that case, instead of a 30-year mortgage, it turns into a 19-year mortgage. In this scenario, because of that home, was estimated being bought, years ago and having equity, it was at 24 months. Now it's at 24 years and 11 months, basically 25 years, really looking at 19 years. So you can still actually pay off your mortgage quicker while doing that and taking that funds to apply that down. And that could be, maybe you don't want to do the full 600, but maybe you're doing 400, 500, or 300, paying some of that down is going to pay that mortgage back quicker and save you money in the long run. And in this case, overall would be, netting yourself $100,000 in paying that down quicker by doing that as well.
Right. I love that strategy. That's a really smart thing to be able to do. I did that at one point too, where I refinanced, and even just the couple months also, that when I refinanced, the couple months that I didn't have to make a mortgage payment, like putting that back into the loan as well, can make a difference too in how long it is, and building all of those strategies in to really save you money in the long run.
Absolutely. Not in here, but another strategy that people talk about of paying down a mortgage quicker is changing to a bi-monthly payment every 2 weeks. And the reason why is because it ends up making a full nother payment in that year. And by doing that, you actually save quite a significant amount. Depends on each person's loan, interest rate, everything, but can often shave off, 3, 4, or 5 years off somebody's loan and save a significant amount of interest as well. So there's lots of things like that you can tweak to be able to pay just a little bit more here and there and save yourself a significant amount in the long run. So, kind of as we've gone over, starting, it's always best to start as soon as possible, a year prior to building credit, throwing that in budgeting as well, depending on financial situations. Taxes are an important thing to look at for self-employed. So, the sooner to start looking at the process, the better. Looking at that current situation, building that budget, and, again, just not getting in over your head. And again, for all this, the sooner the better to speak with, the experts on that. If it's on trying to buy a home or trying to refinance, speaking with a mortgage advisor, a financial coach, really any of that time can help build that process and create, again, that custom plan for you. And I kind of jacked your slide. So anything else there, Jody?
No, you said it well. I love that, just getting a handle over your situation, what it really comes down to, know where you're at, know what you want to go for, and then build the habits and tools to be able to get yourself there. And then taking advantage of people like Jason and myself to really help you, customize a plan for you, a mortgage, learning the tricks and tips like we just talked about, like rolling money back in and payment strategies and things like that, are all great things for people to know to really improve their financial situation. And home ownership is such a great and glorious thing. Sometimes it has its, ups and downs, but as far as finances go and being able to improve your situation, it's a great option. So, if it's something you're looking to do, I'd say, figure out what you can afford and go for it.
Absolutely. Absolutely. Well, that pretty much wraps it up. Any questions from either of you two? You're more than welcome to jump off mute or type in the chat, whatever's easiest. Otherwise, anybody can also, to contact either of us, all of our information is here, from cell phones to websites. And we're both more than welcome to answer any questions and, help people from there.
Absolutely.
Well, actually, I have a kind of random jumping back a couple slides for you, Jody. They may know this on credit utilization. Let's say you have 3 credit cards. Let's say they're all $1,000. One you have maxed out, and the other ones you have at zero balance. So, you're talking about a 30% utilization essentially. But is it done over all 3 credit cards, or does it matter based on 1 credit card?
It is done over everything.
Okay. That's what I believed, but wanted to kind of double check on that as well.
Yeah. But then another strategy I think that you mentioned earlier when we were talking too is maybe you don't have all those cards and you're maxed out, what you can do if you can't pay that down right away is you can always ask for an increase on your credit limit, which will change your credit utilization and could also bump up your credit to help.
Absolutely. And same thing kind of as with a refinance, you just need to make sure to budget and plan and not get in that maxed out situation again with a new higher limit, and just put yourself in a worse position.
Right. And I
Mike,
saw,
I think oh, go ahead, Jody.
oh, I was just going to say that I saw Mike jump off of mute. So
Yeah. But I was, Mike, did you have any questions there?
No, I didn't have any question. I just want to say it was a fine presentation overall,
Well, thank you. Appreciate that, Mike.
though.
thank you.
And,
Thank you for taking the time to join us.
yeah, actually, this is my first time doing this Zoom, so I'm not even sure if my photo, if my picture came up on the screen or not. I don't think so.
No, just your name in this
Okay.
case.
Well, I was working on trying to get that fixed, but like I said, very polished. I touched on all the points that I had a list here I was looking at, and I did take some notes, and I understand that this is recorded also.
Yep.
Okay, so I can view this again later.
Yeah, I'll send it out. Absolutely.
Okay, great. Yeah.
And
wonderful.
you're welcome to send it to anybody as well.
Oh, great.
Perfect. Well, thank you again, Mike, and thank you for the compliments there.
Yeah, thank
Yeah,
you for
thank you.
thank you for the presentation, Jason and Jody. Very helpful. Thank you very much.
You're
Yes.
welcome.
Our pleasure. Well, I think from there, we're gonna go ahead and wrap this up, jump off, and I'm gonna go have some dinner.
All right. Sounds good. And we did good at keeping it at right about an hour. So
Did, yeah. Well, thank you guys again. If you have any questions, anybody in the future, again, here's all of our information. More than welcome to reach out to either of us at any time. Yeah.
Nice.
Thank you.
And
Good night.
Jody, thank you again for partnering with me on this.
yeah, thank you so much. I appreciate it.
Bye.
Good night.